Welcome, Blockhead traders. I must inform you that here at Blockhead Traders, we are not financial professionals, nor should you consider anything we say financial advice. We share our own thoughts and opinions with you, the viewer, so that you can use them as reference points so that you can form your own thoughts and your own opinions and use those to make your own financial decisions. Today is Sunday, April 11th, 2021, and this is Blockhead Traders Weekly. This week we have fellow Blockhead Viper XL 007 joining us, as well as myself, Sprocket 888. And this week is normally tax week. April 15th is coming up. However, in this year, taxes were extended to May 15th, but we decided we'd take this opportunity and just make a few comments about taxes this year and what you might want to think about when it comes to taxes and different things that we do when it comes to taxes. But before we jump into the ever so exciting topic of taxes, I want to put a plug out there for our Discord channel. The Discord room is a free room. There's a link below in the description. Anyone is welcome to join. Myself is in there most days and love to talk with fellow traders out there, get ideas, exchanges, something that you want to know, question you want to ask. There's several different traders in there that will comment from time to time when a dialogue presents itself. I often will mention a few of the things that I'm thinking about trading if I'm going to put trades on in the upcoming week. I usually mention a couple tickers that I'm looking at, things like that. If you watch some of these videos and have a couple questions about something you might have seen, and you don't feel like putting a comment on YouTube, you can always hop in the Discord channel. You can mention myself, Sprocket 888. There's a couple of the traders that could respond as well if you don't want to call out anybody by name. But let's hop into taxes this week. And I think to kick it off, Mike, how's taxes shaping up for you this year?
Learning experience is what they are. So obviously it goes without saying. I mean, we make it clear that we are not trading professionals, and even more so, we are not tax professionals. You shouldn't be either. You shouldn't pretend to be either. So obviously anything tax related, especially when you get into the more nitty gritty of taxes and trading and all that good stuff, consult your tax professional. What we talk about here is just to give you the heads up, to set a context, to set a frame of reference, just things to look out for, things to be aware of. And for me personally, because this past year, I took my step further and, tried to go into doing some, day trading patterns and things like that. And it's been fun. It's been rewarding, but it's also brought with it some lessons learned. So the lesson learned that I wanted to talk about is the wash sale rule. And this is something that, it's not even, it hit me because I was just flying around, playing around with day trading, but it's not even related to that. You could just be a run of the mill investor, and you could run into this. So let's discuss quickly just about what this is and what this means. So let's roughly sketch this out. So let's say we have a timeline here. We'll call this day zero. Day zero is when we make a purchase of a position. So we bought this company, whatever. We bought 100 shares at $15. Make that a little prettier. Okay, so we bought that at $15. Over on the side, let's just say one of our other investment pieces over here has netted us, we're up $1,000 profit over here on something else. It doesn't matter what it was, but we have this profit that we know we're gonna owe taxes on that. This initial position over here that we started, it's not doing great. It came down. It's now at $10. And so we get out and we close all 100 shares. And so, we took a $500 loss on that. Now, maybe one of the things we thought we could do is we were trying to offset, this. We wanted to take a calculated loss for tax reasons. We wanted to claim a $500 loss. So we did this. We sold this off, let's say, around day 10. And the price, but we still believe in the initial position that we made, the 100 shares. We still like that company. So right around day 15, we wanted to get on the books, that $500 loss to try to offset the $1,000 gain we were making on that other position. So day 15, we still think that, like we say, this initial thing, we got our sights set on $20. So it starts to come back up. And it's coming back up around $12. And so we're like, all right, I want back in. So I'm going to buy 100 shares. And now I'm just going to, I'm going to wait and ride this thing up, do whatever I initially planned to do. The problem here is that this is a wash sale. And so what that means is this $500, we don't get to claim it. We just have to, it's a loss, and we don't get to claim it on our taxes as a loss. And the reason that exists is for this scenario I laid out. It's such that you cannot take a loss calculated to try to offset capital gains on your taxes. And the reason, and so then the confines of where this lives is day 10 was the sale. So starting on day 10, you can't touch a near identical position on that underlying for 30 days to avoid the wash sale rule. So really, we were supposed to wait then on day 10, day 40. I guess my day numbering is probably could have been better, but nonetheless, day 40 is when we would actually be clear of wash sale rules. But since I bought back in here on day 15, now I cannot claim this loss. And, that stinks. One of the things about trading to keep yourself balanced is claiming your losses. But that doesn't happen here. It's like me getting hit by that. Obviously I wasn't trying to game the system. I was just, kind of playing around with day trading and whatnot. And it just, as a byproduct of that toying around, I fell into that scenario. I mean, Jeremy actually mentioned it to me and brought it to my attention. He's like, you should look at wash sale. And so I started looking at it and I was like, oh, yeah. Yep, that's a thing that I've definitely been doing. And I noticed that because trading on through the TD Ameritrade platform, they have your gains keeper, and it tells you right away what's marked as a wash sale. So you can still prepare, and I did. And I prepared to make sure to not count those losses. But it still kind of surprised me a little bit coming up on tax day. But that's the gist of the wash sale. I believe that there are some scenarios where this does not apply. Not tax professionals,
correct? But you use these little nuggets as Google inputs for your own learning. Technically, I think you're not actually clear of the wash sale until day 41.
Yes.
Because day 40 still falls within 30 days. And basically the wash sale, like Mike said, is really any time that you sell a security or an option that leads to a security, and then you make the same trade in that same underlying within 30 days forward or backwards of that booked loss. Basically, you cannot use that in your tax benefit. The key point here is that it is only linked to trading with securities. So it is the security themselves, your AAPL, your GM tickers, whatever the ticker happens to be, and it's options that lead you to the right or privilege to buy the equities. However, there are other things that you can trade in the market, notably futures contracts and futures themselves. So those are actually known as 1256 contracts, and those are not subject to the wash sale rules. So what that means is you can go ahead and buy and sell those futures contracts, commodity futures, exchange currency futures, and currency themselves are also not subject to wash sale. So you can trade hands within seconds, minutes, days, hours, whatever, and not have to worry at all about the wash sale with respect to those. One other thing I kind of want to bring up when it comes to taxes and 1256 contracts, I love 1256 contracts because they are a super tax advantageous way to trade, in my opinion. So they have, one, the distinction that we just talked about, where they're not subject to wash sale. Two, they're actually taxed in a special way. So they're actually taxed at what's known as 60-40 split. And so 60% of the profits that you make on any 1256 contract is taxed at a long-term capital gains rate, and 40% is taxed at a short-term capital gains rate. And let's just talk real briefly about long-term capital gains versus short-term capital gains. A long-term capital gain is basically any equity or security or anything that you hold, any capital that you hold. As long as you hold that for greater than 1 year, it's considered a long-term capital gain. So if I bought shares in AAPL and Apple today, and I held that for 356 days and sold it on, or 365 days and sold it on 366th day, after I've had it for 1 year, if I made any money on that, those gains fall under what's called long-term capital gains. And in the U.S., that is typically a much more favorable tax rate than your personal rate. I believe it's currently at 10%, but it really just depends on who's in office and who's in Congress as far as what that rate is. It changes all the time, but it is almost always more a lower tax bracket than your income tax bracket. Now, a short-term capital gain is basically any time that you have some capital shares in Apple, like I mentioned, but you sell it and book a profit before you hold that for 1 whole year. That is considered a short-term capital gain. And basically the rate on the short-term capital gain tax is whatever your income tax is. So whatever federal tax bracket you fall into when it comes to your annual taxes, that's the rate at which those gains are taxed on. And the cool thing about the 1256 contracts, which are all futures, all commodities, and some index funds. So you take a look at that, but some things like SPX or QQQ, I believe those are treated as 1256 contracts as well. But the cool thing is even if I have what would normally be short-term gains, so I buy NASDAQ futures or I buy S&P futures and I sell them, a month from now or 2 days from now or minutes from now, 60% of that profit is taxed at the long-term rate, no matter how long I hold it. And likewise, 40% is taxed at the short-term rate, no matter how I hold it. So if I actually held that stuff greater than 1 year, I would still be charged 40% at short-term rate. So it doesn't matter how long you hold those.
There's other ways you can still offset your capital gains. There's tax loss harvesting. You could, maybe you do want to take that $500 hit, in my scenario to help offset that in a bigger strategy that you have. You just have to keep in mind not to touch that if you want to utilize that loss. Otherwise you'll lose it. And as long as you register a gain, then nothing applies. You're going to pay taxes on that gain, and you can touch that stock. Again, you can pick it up in minutes if you wanted to, if you were qualified for day trading and whatnot. So there's a lot of strategies out there to mitigate tax burdens and whatnot. This is obviously just more focused on
definitely
potential pitfall to make sure that you're
I think it's super
aware
important
of.
to be at least aware that this exists out there, because a lot of times, I mean, like Mike said, it's not just the day traders, right? It extends that 30 days past your sale price. And, you could be getting out because you think the world's ending tomorrow with whatever company it is. And you're like, I'm bailing now. And then all of a sudden the dust settles and you're like, ooh, actually, maybe it's not so bad. I want to hop back in. You just have to be aware that if you get back into that stock and within that 30-day window and you booked a loss, you can't use that loss to offset any of your gains for the year. And again, it only applies to losses. One other thing, I'll just throw a couple terms out there for you. You can look this stuff up on Google. You can do a little bit more research on your own. But one of the other ways to avoid wash sales is to basically have what's known as trader tax status with the IRS. And I'll definitely let you Google and read about that, because having a trader tax status is not really any sort of formal declaration with the IRS. There's really no official, checkbox that you fill in, or there's no official criteria that you'll see from the IRS that says, oh, if you do X, Y, Z, you are definitely trader tax status. It's a very subjective interpretation, and you basically, if you want trader tax status, you just file your taxes as if you have it, and then you basically would prove it if the IRS ever questioned you on it. There's definitely a lot of prior rulings within the court system on what is and what is not trader tax status from existing cases. So most likely, if you're watching this video, you're probably not in the realm of considering trader tax status. So just use it as a research point to know it's out there. And kind of another thing, if you're really interested in taxes and trading and benefits of, different ways you can book things and treat things, you might want to also look up Section 475. So this is a special section of the tax code that only applies to people with trader tax status already. This is a declaration for basically how you book your gains and losses throughout the year. And this is something that you do make a formal declaration on. You would have to inform the IRS when you file your taxes. So right now, if you wanted to declare Section 475 applicable to you, next year in 2021 tax season, you need to inform the IRS when you file your 2020 taxes. So in this case, by May 17th, other years, April 15th, that you are declaring 475, Section 475 status, and that's called mark to market. And what that basically does is at the end of the year, you, on paper for taxes, all of your holdings are considered sold. So, and then on January 1st, all of your holdings that you have are basically rebought, even though you never actually sell them and you never actually rebuy them. On paper for taxes, they do that. So it basically gives you a clean slate every year when it comes to taxes. But the interesting thing about this mark to market and trader tax status and Section 475 is with all those things together, you get to take all of your losses as income, okay, as literally a loss. So normally with your capital gains, you are limited to just $3,000 of losses that you can declare annually. Now you can keep rolling those forward year after year after year, but if you actually wanted to offset more with your losses, or you wanted to book more of that, the trader tax status in Section 475 would allow you to basically treat all gains as income and all losses as income, so they completely offset all of those together. And the one other point that I kind of want to bring up or just kind of talk about here, and I'll just share with you guys my tax strategy and take it for what it's worth. You guys can do something similar. You guys can come up with your own tax strategy. But one super important key point is your broker will not take care of your taxes for you. Okay. It's not like your employer, where when you have an employer with a paycheck, they're going to automatically withhold federal taxes, or they're going to automatically withhold state taxes, or whatever that is. When you trade, that responsibility is yours. And the reason I say this is because the first couple years that I started trading, I knew I had to pay the taxes, and I knew that I was responsible for that. But what I didn't understand is there's actually a penalty from the IRS if you do not withhold enough money. So if you happen to spend a lot of, or dedicate a lot of capital to trading, and you have a lot of gains, and you are not paying the IRS throughout the year for the gains that you have, and you go to file your taxes, and you basically owe the IRS a lot more than what you withheld, they will hit you with a under withholding penalty. I know this because I've gotten it for a few different years for a few different reasons. So this actually has led me to come to the point where I basically, at the beginning of the year, I forecast what I hope to gain in my trading throughout the year. And I then basically break down, if I believe I'm going to have to pay, let's say, $12,000 in taxes, specifically related to my gains of trading, I will divide that up, and every single month I'm going to pull out $1,000 from my brokerage account. Now I put that in basically a high interest savings account, and then every quarter, the IRS, you actually can pay the IRS quarterly. You can log into their website, you create an account, and you basically can pay them estimated taxes on a quarterly basis. And so what I do is I go in every quarter to my gains keeper, or your brokerage will keep track of all your realized gains for that particular quarter. And I look at what my actual gains were in that quarter, and I say, okay, this is what I actually booked as gains. Therefore, I know my tax rate is X. So I multiply those gains by my tax rate. I go to my high interest savings account where I've squirreled away my $1,000 a month, and I basically pull out of that account whatever that tax liability is that I calculate. And I log into the IRS and I pay that for that particular quarter. And, I repeat that every single quarter of the year. So when it comes tax time, my employer's paycheck did their normal withholding that you're probably used to, but I also did my own withholding and my own quarterly tax payments to the IRS, such that at the end of the year, my tax burden basically comes out to about zero, which is what I shoot for every year. Is I don't really like to owe the IRS money, and I don't really like to get money from the IRS. The reason for that is basically, if I owe them too much money, that's a penalty. I would actually prefer to owe just a little bit, but I don't like getting money from the IRS, because that basically means that's money I could have had in my trading account for the year, and I could have tried to get a return on that capital versus giving it to the IRS interest free.
So I mean, I need to move more in that direction to be a little bit more prepared ahead of time. Like I said, getting hit this time, it wasn't massive, and I did my strategy for this past year was understanding what I did for the year, and I didn't really kick things into high gear until late in the year, August, September, through the end of the year. So in that sense, I wasn't trading a whole year heavily. And now that I am this year, I certainly need to adopt more of those strategies in that direction, to either straight up withhold, like you said, if it starts shaping up, that's going to be the path I'm on as far as gains throughout the year. But above all, like Jeremy said, have a plan, and no matter where you're at, even if you're just dinking and dunking, a couple stocks here and there, know what you're goal is, know what you're moving towards. Even if you're just playing, even if you're just getting a feel for the market, that's still a goal. That's still an objective. And so just make part of your strategy to figure out how you're going to handle taxes, and then start Googling terms. Stock trading and taxes. I'm pretty sure that's going to return a lot of hits to start helping you down that path. So have a plan, stick to the plan.
Yeah, for sure. Just kind of second that.
Still
taxes are a thing. They're not a scary thing. I think a lot of people have this preconceived notion that, oh my gosh, taxes are complicated. I can't figure that out on my own. I'm going to hire a guy, which is fine. I mean, you can reach out and hire somebody. But I would encourage you to research a little bit on your own, because, one, if you research on your own, you're going to be able to follow along with your tax professional that you end up hiring, if that's what you in fact do. Two, it's going to help you better as far as planning. You'll go to a financial advisor, a financial tax person, and they'll probably give you good planning advice and things like that. But for me, I always kind of like to try to understand what's going on underneath there. Or, maybe I don't do it all hands-on myself. Maybe I do. But really, Google it and understand what's out there, and understand the environment before you get into everything and start, booking tons of gains or tons of losses. Just understand what the outcome could be and what you hope the outcome could be, and basically, plan for it. You'll be much more comfortable when it comes tax time, and it'll be much less mysterious. But definitely think we've thrown out some good terms in there. Like I said, we're definitely not tax professionals. I can't stress that enough. But hop in the Discord sometime if you have any questions about how I personally handle my taxes. I'm more than happy to share that with you on the Discord or in a direct chat or anything like that. I've talked to lots of different traders, and most of the reaction that I found when people start looking into things is, oh, it's not as complicated as I thought it was. It doesn't mean that you don't still hire a professional and you don't still consult with somebody, but at least, it won't be quite as scary for you. All right. Well, I think that about wraps up our topic on taxes this week. Just a reminder, check us out on the Discord room. Leave a comment below on any questions you might have, topics you want to hear about. Hop in the Discord room to say hello. Let us know what kind of topics you want to hear a show about. This popped up because it's tax time, and we started looking at our taxes and turning everything in, and just seemed like a relevant topic. And we're always open to suggestions and love to cover the stuff that's relevant to you. So let us know, and we'll do our best to cover that. And until then, have a great week. Good luck trading, and remember, think outside the block.